Hey everybody, this is Charlie Dobbins. I wanted to invite you to the next episode in the Masterclass Elite Group Coaching Call. This is a live phone call. If you are listening to this call on June 18th at 8 p.m. Eastern Standard Time, it is live. So if you have any questions, if you want to speak to me directly, you can do it two ways. Either you can type a question into the question block and I will answer it, or if you would like, if you raise your hand, I will go back and I'll check out all the attendees in the group, and I will answer any questions that you have, and I might even take you off of mute, and I will get to see what you have to say. You get to speak to the whole entire crowd. And once again, I see one person's hand is raised, but his hand is always raised, like it just went back up again. So if that person has an actual question, they can just type into the question box and I will address it. Otherwise, we'll just sit back and wait. Now, tonight's call is based upon an actual situation that I was involved in just recently. And what I want to do is show you a trick when evaluating assumption deals, because I see sometimes I almost tell you that 50% of the deals that I look at are assumption deals. So it's very tricky. Assumption deals are very tricky, and I want to make sure that you all understand exactly how they operate. But more importantly, I want to give you a little trick on how to evaluate it. So first thing I need to tell you is I am a lawyer as required by the Massachusetts Bar Council's office. I'm here to tell you that I'm a lawyer. I'm not your lawyer. Get a lawyer. I was down in Atlanta this weekend, and I asked a member of the owner forum who happened to come listen to me speak. I said, "What's my disclosure?" And he nailed it 100%. I'm a lawyer. I'm not your lawyer. Get a lawyer. And that's exactly what I want you to understand. Okay. Now, before we get going, I know this is a shameless plug. I am not a shill type of person, but I want to make sure that everybody knows about this because we've already got a pretty good turnout for this event. I'm very excited about it. It is my multifamily due diligence seminar. If you guys are thinking about buying apartments, you should be coming to this seminar. It is 2 days. The seminar is 2 days. I know it says 26th, 27th, 28th, but the seminar is actually the 27th and the 28th. Members of the owner forum can come to dinner with me in the north end of Boston on the 26th. And so please make sure you register. If you look down here in the bottom, it's got multifamilyinvestingacademy.com/due diligence. That is the website for what you're looking at here, and this is how you can register for the event. I'm telling you, folks, it is the most intense 2-day multifamily training you will ever have. I guarantee it. So, all right, now, let's talk about what happened to me today when I was talking to one of my clients, one of my owner forum clients, about a deal that he was working on. Okay, so what he said, he sent me over the offering memorandum and he sent me over his cash flow analysis. And then he said that the broker stated that the seller was looking for $13.5 million. Okay, fine. But near the end of the conversation, the student detailed for me the loan terms, which I thought was kind of strange. He said it was $5.6 million was outstanding on the existing loan with an interest rate of 4.15 at a 30-year AM, and there were 8 years left on the term. And I thought to myself, why is he telling me this stuff? This is very strange. And I said, hold the phone. Why are you telling me loan terms? What is this? An assumption? And he said, well, yes, it was. And right away, everything changed. Okay? What I then did is I figured to myself, oh my gosh, the broker is asking for $13.4 million, and we have an existing note, and I need to now go back into the cash flow analyzer and revise the offer because it's an assumption. So my first question to him was, how long has the note been in existence? Now, you have to understand something, folks. The reason why I asked that question was because of what we're talking about here, the trick. If he can give me that information, I can get into a particular mode of valuation that I need to get into. So let me show you what I mean. He said that the note was originated in 2014. 2014. I'm in 2015 right now. I'm halfway through it. And I thought to myself, this note isn't even 2 years old. It isn't even 2 years old. That means that the seller had to go through the whole banking process less than 2 years ago. And now he's trying to sell the property and have me assume that note that isn't even 2 years old. So let me ask you something, folks. What do we know about multifamily investing? The first thing we know, and we know a lot just by basics, but the first thing we know is that properties tend to take on an 80% LTV, loan to value. That means that if a property goes out to get first mortgage financing on it, it tends to trade at 80% of the loan to value. Okay, so just keep that in mind. I'm going to walk you through this stuff. You might want to take down some notes, and this is being recorded, so it will be up on the group coaching site. But to follow what I'm about to show you, you might need to take some notes, or this will be up tomorrow on the website. You can go back and listen to it then if you didn't listen to the notes. Okay. So let's say, for instance, that assuming that there was little to no increase in the net operating income of this property from 2014 to now, what is this property worth? So let's say, for instance, that, use my Latin, ceteris paribus, all things remaining equal, the net operating income in 2014 is the same net operating income as we have now in 2015. What's the property worth? Let's take a look. Now, we know that the outstanding mortgage balance is $5.6 million. Now, if it was trading at 80% loan to value, in 2014, when this guy went out to take out a mortgage, an 80% LTV mortgage, what would the bank have said his property was worth? $7 million. Do everybody see how that works? Let me go back. You take the $5.6 million of the existing loan. Here's the trick. This is it. When the assumption, when the broker tells you how much is outstanding on the assumption, and you figure that it was 80% of a loan to value, right away, by that simple little formula, the property was valued by the bank in 2014 for $7 million. Okay? That's the trick. Now, I'm guessing, let me just check my phone here. That took me 9 minutes of this call to tell you the trick. Should we end now? No, I'm going to give you a little bit more so you get a better handle on how this whole thing works. All right. Yeah, so let me just see. Some people are putting in answers. And it's always Bob Bryant, smartest man in the world. And he understands exactly where I'm going with this. Or maybe he doesn't. Maybe I have to drag him kicking and screaming. All right, so we know that in 2014, this property was valued at $7 million. What's the broker asking for 2 years later? He wants to sell this property to you for $13.4 million. Let me go back to my buddy Bob. Bob, is that value? Is that value to go from $7 million 2 years ago to $13.4 million today? And Bob says, don't have a clue. Okay. All right, Bob, by the end of this conversation, you will definitely have a clue. I guarantee you. All right, so the broker's asking for $13.4 million. We just know that the property traded the bank said this property is worth $7 million 2 years ago. okay, man, that's a huge discrepancy. That's a huge discrepancy. That's a 91% increase in value in 2 years on a multifamily property. Multifamily, because of the fact that the valuation is based upon a formula, does not increase. If it's a performing asset, it does not increase by 91% in 2 years. Okay? But this broker is asking you to buy that, to believe it. Nice work if you can get it. Now remember, this is a new loan on a performing asset, which means that this is not a repositioning. Okay? Now, why am I making that clarification? The reason why I'm making this clarification is because if this was a non-performing asset that required repositioning in 2014, then you might be able to pull off some type of a reval that shows that type of a distinction in valuation from a 7 million to a 13.4. But because of the fact that we know that this property traded 2 years ago or was given a mortgage 2 years ago, that means that it was a performing asset 2 years ago. That means that it's still a performing asset 2 years later. And that means that there was no repositioning. So because I know for a fact that there was no repositioning because of the way that these notes are set up, then I know that a 91% increase in value on a performing asset is outside of the realm of possibility. Okay? Now, but Charlie, you said this was a formula-driven business. And if the numbers work, you buy it. And if the numbers don't work, you fix it. And if you can't be fixed, you just move on. All right? So if the numbers work, then even though the numbers are considerably higher, like 13.4 million, we should buy it, right? So if the numbers work at 13.4, we buy it, right? Well, it's kind of like a second marriage. It's like hope over experience here. What do we know? Let's think about this for a second. Let's go back and just evaluate what we know at this point. We're detectives right now. And we're getting to that point in the case where we're running out of leads. So we go back and we evaluate what we know. We know that the original purchase price was $7 million. How do we know that? Because we know that the loan to value was 5.6. We know that the loan amount was 5.6, and we know that on the vast majority of these mortgages are done on 80% loan to value. And by using that, we know that the original purchase price was $7 million. Okay, fine. Let's stipulate to that fact right now. The new asking price is $13.5 million. That's a difference of $6.5 million, or like we said before, 91%. Now we need to go back and use the formula, and this is where it gets really interesting. So first thing we need to evaluate is the cap rate. Now in this particular case, the cap rate by the broker for this particular type of asset was 6%. So it's a good solid B-class asset. It's performing well, and it's being valued at 6%. Now if it's at 6%, if the difference in valuation from what the broker is asking today to what we figured out the guy valued it 2 years ago is 6.5, and the cap rate is 6%. What's the difference in net operating income from the old valuation to the new valuation? Are you following me here? Let me show you. If we know the difference in valuation is 6.4 million, and we multiply it by a 6 cap, that means that the difference in the net operating income between the 13.4 million and the 7 million is $384,000 per year. That means that this property needs to generate on a net basis, after expenses and income, it needs to generate on a net basis $384,000 of new income in 2 years. Remember, folks, this is just a formula, and these formulas don't lie, all right? Take taking my little swig of water. Now, watch this. That means the owner had to increase the annual NOI by $384,000. Bravo! Bravo to him. But is that realistic? So you can sit there and let a broker try to blow smoke up your skirt telling you that $384,000 is realistic on this property. But let's break it down. Let's take another look. Think about it this way. This property has 305 units. So if we take $384,000 and we divide it by 305 units, that means that each unit has to generate new income on a net basis of $1,259 per unit. Divide that by 12 months, that's $104 per unit per month in net increase. That means that every tenant that was in this property from 2 years ago until now has to pay an increase in their rent to the tune of $104. I'm telling you right now, folks, from my own personal experience, a tenant in a C or B class property will not pay $104 more per unit per month. They will leave. Now, if they leave, okay, fine. You have to make sure that the person that comes in after that can afford this higher rent. And that's the big question. And that's something you will need to do in the due diligence process. And this is, and here's my shameless plug, and this is something we talk about in the due diligence process at the class at the end of the month. Okay, now, is $104 per unit per month realistic? In my professional experience, absolutely not. There is no way that this property has been able to increase its value by increasing the rents and the net operating income by increasing the rents by $104 per unit per year to the same clientele. You got to move the clientele out to get $104 more per month. I'm telling you that right now. All right. So the additional NOI needed to validate this increase in purchase price does not pass the formula test, the test that we laid out there as what needs to happen in order to make this deal go. So, what did we learn? And for those of you that are Family Guy fans, you know this famous scene of Stewie at the baseball game. So what did we learn? What we learned is when working with assumptions, you can easily back into the value just by knowing the loan amount. And what I also should add in there is, and the year that the loan was taken out. If it's a very new loan, 1, 2, 3 years, then you know that the valuation is not going to have changed that much. And if a broker comes along and says, "Oh no, this is no big deal. You can do this," no, don't buy them. Brokers are liars. All right. So that's tonight's trick question. And after having done that, let me go back here because I don't want to I don't want to lose that screen. So that is it, guys. I know this was kind of a funky question. Let me take a look at some of the questions that people have asked in. Can we call the brokers bluff? Oh, you had better believe we are. Brokers, and I hope I don't offend anybody because I can be offensive, but I'm here to tell you right now, brokers are liars. They will tell you what you want to hear. And so if the broker tells you that the property is worth 13.4, but you've gone back and you've done your homework, guess who's right? You are. You are always right. I had this question. Now, hold on a second. Let me just check to see who's on the call right now. No. Okay. Let me see. Let me see. No harm in that. Okay. No way. Exactly. But it's only. Let me just see if this one particular student is on the call right now. And I think he was. Let me see. Where are you? Yes, he is. Okay. So I had a student who happens to be on this call right now. He and I had a conversation this morning about his LOI. And the broker came back and said, no, you know, you need to be here. And he and I went back and we looked at our numbers again, and we dug deep down into it. And I said, no, you're not changing your number one bit. I mean, first off, the broker hasn't even countered. He hasn't even presented your offer. But not only that, your offer is so easily substantiated. The numbers make total sense on your side. So why are we even having this conversation? Submit the offer and let the broker have to explain to the seller why yours is a very valid offer. And based upon the cap rate, the NOI, all those things, your number makes total sense. Don't change it for the least. So, you know, should we call the broker's bluff? Absolutely. Yeah, so this particular student just said, he who has the gold makes the rules. The buyer and financiers are always right. You know what? That's a great point. He said, this is the student that I just was talking about, just typed in and said, he who has the gold makes the rules. The buyer, you folks, and the bank, the financiers, are always right. They are the only ones writing the check at the closing table. So they have to be right. So when the broker is trying to tell you that the numbers should be this and the numbers should be that based upon his pro forma, baloney. Call his bluff. He's crazy. He's nuts. And brokers lie like you can't imagine. Okay. And the question is, but isn't the broker working for me? No. Broker works for the seller. Nobody works for you. You work for you. Don't believe anything anyone tells you, and always protect yourself. Yeah, and also, you know, as this one student just said, he who wants it least wins. Remember, the thing about this property when you're buying property is that the seller is stuck. He owns that property. He can't go anywhere. You are a potential buyer. You can go anywhere you want. And so for this guy's deal to make sense to you, for it to work, it had better be a darn good deal for you to get into it, because you can walk away at any point and that guy can't. Okay? So let's see, what's our next question here? I'm saying that we can based upon what you've said. Okay, I guess I misunderstood. This one particular student has posted the second part of a question that I already deleted, so I can't quite remember. It says, I'm saying that we can based upon what you've said. All right, so please, that student, if you could kind of clarify your question, give me a little bit more narrative there so I can help out. Okay, next question is, what if the broker suggests that the price in 2012 was due to the market conditions then, emerging from financial crisis and all? Well, that's fine. What that tells you then is that the value back in 2012 wasn't a true arm's length transaction. It was a distressed property. So if we're looking at it back then, and he's saying that it was due to the market conditions, one thing you've got to take into consideration is that the lender lended on this property at an 80% LTV, or approximately an 80% LTV. And the only way a banker would do that on this type of property is because it's a performing asset. So much for the financial crisis in 2012. It wasn't so bad that this bank decided not to give the loan. So that's baloney. That's another example of a broker giving you bad advice. You've got to look at the numbers. The numbers tell all. If there was a market condition issue back in 2012, it will show up in the numbers. It will show up in reduced rents. It will show up in compressed or a different cap rate. All of those things will apply. But right now, we're looking at the situation. Now, think about it, folks. What I didn't even talk about in this analysis is this. The broker's asking for 13.4. The loan is at 5.6. The seller wants you to assume the existing loan. What does that mean in your down payment amount? 13.4 minus 5.6. Let me pull out my little calculator. 13.4 minus 5.6. 13.4 minus 5.6 is $7.8 million. That means that to buy this property, you have to come up with almost $8 million of cash, private money, to make this deal happen. 7.8, let's do 7.8 divided by 0.2. If 7.8 was the amount of money that you raised, and if you knew that multifamily property required 20% down, a 7.8 raise means that you can go out there and purchase $39 million of multifamily property if you went out there and raised $8 million. Now think about it here, folks. Are you seriously going to go out there and raise $8 million so that you can buy this overpriced $13.4 million assumption? What you want to do is go out there and take the $8 million and buy $40 million of property. And like one of my friends here says, start a fund when you raise $8 million to go out there and buy a whole stretch of $8 million of $40 million deals. Okay, so that answers that question. Let me see. Okay, I think I'm saying we can call the broker's bluff, given your yes, absolutely. Oh, thanks, Mike. Yes, you can definitely call a broker's bluff. Listen, there's only one person showing up at this closing table writing a check for either $7 million or $13.4 million. Only one person. Everybody better be just kissing that guy's butt. So make sure that you get out there and get what you are entitled to, and especially in the form of valuation. So if the broker's asking for 13.4, call his bluff. Show him where his numbers are wrong. Make him look like an idiot, because he's not writing any checks at the closing table. He's just walking away with one, and it's going to be your hard-earned money, okay? So that is it. Any other questions that I see up here? I think I've just banged through most of them. And look, we're going to get done at 8:30. Super. Okay. So if anybody has any more questions, just type them right here. Let me just wrap it up by saying two things. First off, due diligence seminar. If you have any questions about it, you want to know what it's all about, give me a call. Here's my cell phone number. Get ready to write this down. I'm about to give it to you. 3, 2, 1. My cell phone is 781-987-4765. Shoot me a text message or give me a call, and I'll explain to you how the due diligence program works. You will greatly enjoy it, I promise you. And then the other thing, just if you're on the Owners Forum, you know that I've sent out a couple of emails in the last couple of days, just kind of giving you an overview of some of the changes, because I've really had to revamp that program. The first couple of months is really in a beta program, and I think I've come up with a couple of things that will help us remain connected. So if you could go to your emails and follow those instructions. I sent you an email this morning telling you about the closed Facebook group, about the what the heck is the name of that other thing? Not Hangouts, but WhatsApp. WhatsApp is another one. So make sure that you go and look at that email, and make sure you get aligned, because we're going to be talking for the first time Sunday night at it's either 7 or 8. I can't remember which. I think it's 7. Sunday night, 7 o'clock. It's kind of like a quick overview. We all kind of get together, and we talk about what we're going to be doing on this upcoming week. So for those of you in the master class that are not members of the Owner Forum, it's definitely something you want to think about. I'd love to have you on board. It's a lot of fun. I'm enjoying it so much. So, all right, one final question. In an LOI, Should you make even number offer or an odd number close to your offer number? I tell you something. There is a methodology to what your offer number should be. You never want to make an offer that's like 13.9. Why would you make an offer of 13.9? You want to make your offer look really strong. Well, then bump it up by $100,000. Make it 14. Now you are way ahead of anyone that has an offer with a 13 in the number. Okay? So think about your audience when you're making an offer. What is it that you want the guy to see when you make that offer? And part of it is thinking about that first number. So many times you hear brokers say, well, let me tell you something, he's not going to accept anything that doesn't have a 5 in front of it. Okay? Then we know our minimum offer to make this deal happen is going to be $5 million. So that's how you need to think about making your offer. Yeah, that's kind of how you want to go after it. I think I don't know a difference between the odd and the even numbers. I think it has to do with that first number and making sure if you're close to the next number up, go for the next number up. We'll knock it down in the due diligence. But you'll be giving the seller most likely what he's looking for. So, all right, everybody. Good talking with you again. As usual, if you have any questions, just shoot me an email at info@multifamilyinvestingacademy.com. On Owners Forum members, I will be talking to you on Sunday night. And then if also Owners Forum members, if you need me, just shoot me over an email or a text. I'll be cleaning out everything before I leave tomorrow afternoon. So make sure that you get on board if you need me. So, all right, folks, I so appreciate your time. I look forward to working with you. And some wise guy just told me sweet dreams. Nighty night. Yeah, okay, fine. And I will chat with you all later. Thanks, everybody. Great talking with you, and I'll talk with you soon.